Hello and welcome to our Fireside Chat series, Stable Value Strategies, Navigating Uncertainty with Confidence with Lincoln Financial. I'm David Braham, Executive Director of Content at Institutional Investor, and I have with me today Jayson Bronchetti, Lincoln Financial's CIO, Chief Investment Officer. Jayson, thank you for joining us.
Great to be here, David. Thanks for having me.
The Fed to date has very much been in a wait-and-see mode in regards to interest rates. Jayson, we would love to hear your outlook on interest rates and what you think may lie ahead. But also, how will it impact portfolio construction and what's the role of stable value solutions may play given the interest rate environment?
Yeah, well, to your point, the idea of wait and see has held true yet again as the Fed, on balance, opted to hold rates steady this past July. Before we jump into rates, I think it is worth taking a step back to look at the broader market landscape because it really sets the foundation for these decisions. So far in 2025, despite ongoing uncertainty, the economy has proven to be really remarkably resilient. Equity markets hit all-time highs in July. Inflation is running at a manageable 2.5% to 3%, and unemployment is at 4.2%. And then consumer spending has remained healthy. Corporate investment, and notably across the tech and infrastructure sectors, is actually picking up. And so all of this supports a cautiously optimistic outlook on the economy. And just to put it simply, the economy is growing without overheating. Inflation hasn't been quite the problem many expected earlier in the year, and jobs are stable. And so I think that mix gave the Fed little reason to make a move in July, choosing instead to let the current conditions play out. And I really believe that rather than trying to time rate moves, it's more useful to focus on these underlying economic drivers, because at the end of the day, if the economy is strong enough to avoid cuts, it's likely strong enough to generate earnings growth. And if it's weak enough to require cutting rates down to 1%, like the administration has suggested, it likely means that we have bigger problems than Fed policy. I think the most likely outcome is somewhere in between those two extremes, with modest gradual cuts. And ideally, if we don't see a sharp and sustained uptick in inflation, this would give central bankers space to ease more slowly, perhaps once in September and then once, maybe twice again before year end. The key variable is going to be, I think, the tariff pass-through in the third quarter. So that's what I'm watching. If we see inflation accelerate sustainably beyond 3% as those tariff adjustments work through the system, the Fed's likely going to prioritize their credibility on price stability over accommodation. Of course, this can change rapidly as those conditions evolve. So looking further ahead into 2026, the expectation is for additional cuts as the Fed continues this gradual normalization process. And it's fairly clear the Fed has a bias toward easing at the moment. So the reality is that rates are likely to continue ticking down over time. But again, it's going to be a measured approach rather than a dramatic move. And the neutral levels will likely end up being higher than we've gotten used to over the past decade. This creates, I think, an interesting backdrop for income-focused investors and savers. And this is where stable value solutions come into play. In today's environment, they're especially compelling because they may deliver more predictable income. So even when Fed rate moves are making headlines, you have that stability. And these solutions are designed to smooth out rate volatility. The crediting rates adjust gradually and often come with built-in floors, which can help protect against sharp declines in rates. So that means participants could see steady, reliable income streams over time. Now, it's important to remember that these solutions may offer limited growth potential and may not always keep pace with inflation, something to consider when building a balanced portfolio. But with that said, from a portfolio construction standpoint, stable value solutions can be a simple way to bring both stability and income, two things investors are looking for right now. And the bottom line is this: in a world where we're preparing for a continued, albeit gradual, decline in interest rates, stable value solutions can help provide that ballast for the portfolio that's particularly attractive for retirement plan participants. And these portfolio solutions may offer investors income predictably while we navigate this policy transition. And that can create real value when everything else feels uncertain.
Jayson, thank you very much. And thank you for showing the benefits of stable value solutions, bringing stability, income. Isn't that what everyone wants? This concludes our Fireside Chat series, Stable Value Strategies, Navigating Uncertainty with Confidence with Lincoln Financial. Thank you all for watching. Take care.